Hello, 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 powerful people. Millen Livis is here, your holistic financial independence mentor. Welcome to part 4, the last video in the mini training series, Investing in the Stock Market Using Index Funds. Today we'll talk about 4 potential warnings about index funds. You may have noticed that investing in index mutual funds and ETFs gets a lot of positive press, and rightly so. Index funds, at their best, offer a low-cost way for investors to track popular market indexes, right? That's what index funds do. In many cases, index funds outperform the majority of actively managed mutual funds. One might think that investing in index fund products is a no-brainer. Not surprisingly, the providers of mutual funds and exchange-traded funds, ETFs, have created a bunch of new index products in response to popularity of index funds. With this being said, I want to share with you 4 things you must know about index funds as you plan your investment strategy. Okay, 4 things that you must know. Okay, first of all, not all index funds are cheap. People who work for large corporations often have the opportunity to invest in low-cost index funds offered in 401k plans that offer institutional shares of certain funds, right? If your 401k plan contains index funds from providers such as Vanguard Group or Fidelity Investments, you can be pretty confident that these are low-cost funds. Both funds from these families offer share classes with even lower expense ratios and also offer a full range of index funds across various stock and bond asset classes. Unfortunately, 401k plans do not always offer index funds that cheap. This may be true if your plan provider is an insurance company or a brokerage firm that offers its own proprietary funds. Okay, while the advice to focus on index funds in your 401k plan is often sound advice, make sure that you look at index funds offered in your plan to ensure that you are making the best choices. Look at the expense ratios, fees, everything that I shared in the previous trainings. For 401k participants who are fortunate enough to have a selection of several low-cost index funds, the advantage over high-cost actively managed funds can be significant. All right, number 2, not all index funds are created equal. There is a wide range of low-cost index mutual funds and ETFs that cover widely used market indexes, domestic and foreign stock indexes. However, just because a fund says index fund in its name doesn't necessarily mean that it tracks the underlying index or sector in its entirety. When screening for an index fund, it's important to remember that not all index funds labeled S&P 500 or Wilshire 5000 only follow those indexes. Some funds can have divergent management behavior. Okay, in other words, a portfolio manager may add stocks to the fund that are similar to what's in the index or remove some stocks. It's important for investors to analyze the holdings of the index fund before investing to determine whether it's a true index fund or it's a fund that has an index-like name, right? Just keep this in mind. Also, it's important to understand the investment manager's goal for the index fund that they manage and what holdings or investments are included in order to reach this goal. If the goal is considered aggressive, the fund's investments might deviate from the underlying market index. Okay, the need to consider fees becomes even more important relative to increased risk factors. Fees reduce the amount of return received for the risks taken. All right, let's move on to reason number 3. Warning number 3. Index funds don't necessarily reduce the risk of loss. Investors in an index fund or ETF, tracking, for example, the S&P 500 during a bear market in the stock, will experience losses just like an index, okay? So index fund will not protect you from the losses that underlying index experiences. In a broad-based sell-off, like we experience right now, investors in other index products tracking real estate in the form of real estate investment trusts, for example, REITs or emerging market stocks, could suffer large losses as well. Index fund investors do, however, eliminate management risk. This is the risk of an active manager underperforming the benchmark, the actual underlying index associated with their investment style due to investment choices they make in managing the fund. So this is eliminated, management risk. While occasional adjustments to the index funds do not impact most buy and hold investors, informed investors should stay on top of their index funds holdings for changes like this, right? As mutual fund providers continue to compete on price. Okay, so next warning, number 4, is index funds don't ensure investment success. I wish it was different. Just investing in an index fund or two doesn't mean that you are on your way toward achieving your investment or financial planning goals. Index funds are tools, just like any other investment product. In order to gain the most benefit from using index funds, either exclusively or in combination with stocks and ETFs, you've got to have a strategy. Index funds work quite well as part of an asset allocation portfolio, overall asset allocation plan. Many financial advisors put together portfolios of index funds that are allocated in line with their clients' risk tolerance and their financial plan. Others may use a core and explore approach where index funds make up much of the portfolio, the core portfolio, with selected active funds to hopefully enhance returns, to explore some growth opportunity. All right, so the bottom line, investing in index mutual funds and ETFs can be an excellent low-cost strategy for all or part of your investment portfolio. Index funds is a popular strategy for investors who seek passive index strategies as opposed to active management. Indexing has several benefits, including lower cost, broad-based diversification, and lower taxes. Investors, however, must consider the index fund that they select, since not every fund is low cost. Okay, we talked about this. And some may be better at tracking an index than others. And finally, owning the index fund doesn't mean you are immune from risk or losses if the markets take downturn. Unfortunately, that's what is happening right now. Like any other investment strategy, investing in index funds requires that you understand what you are investing in. Not all index products are the same, and investors need to look beyond the name index fund, beyond the label, to ensure that they are truly investing in a low-cost product that tracks a benchmark, an underlying market index that fits with their investment strategy. That's all I have for part 4, the last training in this mini training series. If you have any questions, go ahead and post them in the comments. And if you want to discuss your financial goals and investing strategy with me, book your Never Worry About Money Again consultation at speakwithmillen.com. Thank you very much for your time today. Thank you for watching. Thank you for your attention. Stay blessed.